And so what's special about this company is that they have figured out how to manufacture this stuff at scale, and they're going to be raising money to build a manufacturing facility to actually do this. And I've basically been saying, as I've been investigating the company and learning more and more about it, that they're going to have to change the name of Silicon Valley. It's not going to be Silicon Valley anymore. It's going to be this company's Valley.
All right, everybody. Welcome to the Angel Research Podcast. We are here as usual today to discuss the market's hottest stock stories and investment opportunities. We have a special episode today where we are going to be hyper-focused on a relatively new investing strategy, a private investing strategy that allows everyday traders like you and me to sidestep the stock market and make money the way that the world's richest people have been doing for years. Talking about people like Elon Musk, Jeff Bezos, Bill Gates. You get the idea. This is the one thing that all of them do to become enormously wealthy. And that is specifically purchasing shares of private companies before they go public, typically at massive discounts to IPO prices. For years, this kind of investing has been reserved or privy to the wealthiest of Americans, but new laws have opened the floodgates for pretty much anybody to invest. There are no income requirements. You don't need to be related to a company founder. You don't need to have any real special connections, anything like that. All you really need to know is a guy like our guest, Jason Williams, here today, who is well-connected and knowledgeable enough about this specific kind of investing. And fortunately, he is here with us today to give us the ins and outs of this investing method and these simple steps that you can follow to participate. So, Jason Williams.
Hey, how's it going?
Welcome to the show. I think maybe a good start is for you to give the audience a primer of your background, who you are, your time on Wall Street, maybe some of your experiences on Wall Street, and why you left Wall Street to serve the Main Street investor.
Okay, all right. Sounds pretty straightforward. So as Jason said, my name is Jason Williams. I got my start in finance working for Morgan Stanley. I always say I was in the belly of the beast, because we were I think at the time, the second biggest investment bank in the world, second only to Goldman Sachs. I got to work there. I got to work with some of the smartest people, some of the best investors in the world. And I learned a lot from them when I was there. But one of the things that we did at Morgan Stanley was what's called book running, right? And the book runner is sort of the company that helps, the book runner is the bank that helps another company go public. And go through their IPO, shop the shares around to everybody. And so I watched Morgan Stanley facilitate the IPOs for General Motors did a new IPO after they declared bankruptcy and relisted their stock. We handled that IPO. We handled the Facebook IPO. We handled a lot of these billion-dollar IPOs. And what I was noticing was that our customers, the ones who bought the IPO on the primary market, which is bought it directly from the company that was going public. They made some money, and they were usually able to sell it for a little bit more on the secondary market, which is where people like us trade. But the people who really, really made the big money were the insiders, the ones who already owned shares in the company and who, instead of buying at the IPO, were selling at the IPO. And, I'm not the kind of guy that could sort of sit there and plug along happily when I know something way better is out there. So I got really interested in that market. And I was like, I want to know how to be a private investor. I want to get in on this. And usually the people, that are cashing out at the IPO are founders. They get what's known as sweat equity, where, instead of being paid a paycheck, they're paid in shares of the private company. Early employees oftentimes are given restricted share units or options to purchase shares in the company as part of their compensation package, sort of to lure them in and be like, hey, we can only afford to pay you $30,000 a year. But if the company goes public, you might be a millionaire. So it was usually those people, but then it was also venture capital. Venture capital, people with deep pockets that basically these companies had gone to and said, look, we need money to continue to grow. And we're willing to give you, equity in our company, a piece of our company, if you can provide some of that money for us to help us get where we're going to go. And so, those are really the only people that weren't, friends and family or employees or founders that were really getting paid in these IPOs. So that was the part of the market that I really wanted to get into. But the thing is that there's literally rules up until a few years ago that said that you cannot invest in a private company unless you're what's known as an accredited investor. And so an accredited investor either has, all the certifications that I had to get when I worked on Wall Street, Series 7, Series 63, all of these tests and stuff that like professional traders, professional investors have to get in order to sell securities and things that proves that you know what you're talking about. Or you have to actually already be rich. You have to have at least $1 million net worth outside of your house. And most of us, if we do have $1 million net worth, it includes our house that we live in, and that doesn't count. So if you were already rich, you could participate in these things and get richer. But if you weren't already rich, then you couldn't participate in the most lucrative market in the world. And that just sort of struck me as kind of ridiculous. And
yeah,
so,
it definitely sounds like a rigged game.
Oh, totally. 100%, you can be, if you're not rich, but your friends and family, you can invest in these companies. And that's how a lot of like politicians sort of get into it, is because, like if you're a politician, well, you can be anybody's friend. If you help them get their company out there. So like, this is where you see like, this is how family fortunes are built. And like you said, when you gave your introduction, one thing that really ties all billionaires out there together, or almost all billionaires together, is that they all own shares in private companies. And that's really how they made most of their money. Mark Cuban, from Shark Tank, Kevin O'Leary, Mr. Wonderful, like both of those guys founded private companies and sold them, and cashed out when they sold them and became multimillionaires and eventually billionaires from it. Elon Musk, the reason he's the richest man in the world is because he owns so much of Tesla. And he owns so much of Tesla because he's one of the founders of Tesla.
And there's no income that's going to get him there, right? Or no salary that's going to get him there. It's all from investing and getting in at like enormously.
And really, there are no billionaires out there that made the, I don't want to say that they didn't work for it, because they obviously worked for it. Elon Musk worked really hard to build Tesla to what it is today. But you don't become a billionaire by collecting a salary. You become a billionaire by investing. And most of the time you become a billionaire by investing in private companies. Warren Buffett, you could take him as maybe like an exception. He invests mostly in publicly traded companies, and he became a billionaire. But he became a billionaire really, really slowly. If you want to do this fast.
Yeah, like, Berkshire now too is a lot of private companies, right?
They do own a lot of private companies. They've taken companies private themselves. They've invested in other private companies. But yeah, really, like you have to, if you want that explosive growth, that's where it comes from. And back when I first started, getting interested in the stock market in general, there were like twice as many publicly traded stocks out there. But that number has shrunk and shrunk and shrunk over the years as companies stay private longer, because they had access to all of this money. And so that's really where this new type of investing comes in. And that's why I'm really so excited about it, because it allows people who are regular rank and file retail investors who aren't already millionaires to make the kind of investments that could potentially make them millionaires.
Okay. So yeah, could you give us some more details on this? I mean, I guess maybe tell us when this legislation was passed. I know that it's been passed in the past couple of years. And then there's two different kinds of, is it two different separate legislations, right? The Reg A and the Reg CF, or those two?
So they're all part of the same legislation.
Okay.
They were all sort of slipped into the Jobs Act, right? Which is stands for Jumpstart Our Businesses and Startups Act. And so after the 2008 financial collapse, it was really tough for small companies to get investments. People were scared, like what's going to happen? We just went through the dot-com bubble bursting and lost so much money. We just went through this really deep recession and lost so much money. And basically Congress wanted to jumpstart that funding again. And so they sort of, I like to say they snuck this into the legislation because, prior to that, the law, the laws that have been passed by Congress were keeping regular people out of this market. And so like they definitely sort of snuck this in to allow us to get into the market. And basically it's what a lot of people have heard of as crowdfunding. Right. But most people think of crowdfunding as like, like a GoFundMe page. Like I need help paying my bills, so I'm going to post a GoFundMe page and see if people will, give me like like a couple $1,000s, or somebody needs a surgery, or somebody got into
Sure.
a car. But there's actually this thing called equity crowdfunding, where basically companies can go out there and through various portals online, they can post their shares and allow people to invest. And oftentimes the minimum investment is $100. So with $100, you can get a stake in a company that could be the next Tesla, a company that could be the next Amazon. And this is the first time in like almost 100 years that people were able to do that. And so you mentioned that there's two kinds of rounds, Reg CF and Reg A. And the Reg stands for regulation. So regulation CF it literally stands for regulation crowdfunding. And those are smaller rounds, and usually what would be called in venture capital seed stage rounds, where it's a very small company. They have a team, they have an idea, they know what market they're going after, and maybe they've sort of started executing on that idea, but they're very, very early stage. And those rounds are much smaller. I think the maximum that they can raise in those rounds is $5 million. But those are also the rounds that usually have the minimum of like $100 to invest. Then you move up to what's called a regulation A round. It's a regulation A plus round. And in the A plus rounds, you can raise up to $50 million. And so usually these are much more advanced companies. These are companies doing what in venture capital you would call a Series C or a Series D round, which is like the funding round that they do right before they're ready to go public.
Okay.
So most of these regulation A companies, they plan to go public. They plan to list on the stock markets. And this is sort of their last funding round or fundraising to sort of get them over that hump, so that they can become publicly traded.
So what I found like really crazy about this is that this law has been around for a while, right?
It's almost a decade now.
Yeah. So, but not a lot of people are investing in it.
No, definitely not. Not many people are taking advantage of it. I mean, not many people even seem to know about it.
Yeah. So that's pretty crazy. And that's kind of, I want to transition the conversation to what you do. And you kind of try to put this investing method in front of people's faces and try to make it more accessible for them with your Main Street Ventures newsletter or investing service.
Yep.
Could you tell us a little bit about that? Maybe tell us, what does your audience get? How many deals are coming through every year? Just give us all the details on that.
Yeah, for sure. So, I mean, Main Street Ventures, you mentioned, is the name of my investing service. And basically the reason I founded it is because this is such a lucrative type of investment. But like you said, not many people seem to be taking advantage of it. Not many people even really know about it. So Main Street Ventures is sort of my way of getting the word out to regular investors, because that's why I left Wall Street. If I wanted to continue to help rich people get richer, I would have stayed at Morgan Stanley, and I would have cashed big paychecks, and I would have gotten $1 million bonuses. But that's not what I wanted to do. I wanted to help people who really needed help. Like people who are already billionaires in my opinion, don't really need the help. They're fine. They're billionaires. If they lose half their money, they still got $500 million. So that's why I left Wall Street, and that's why I founded Main Street Ventures, because I really want to get the word out there. But I also know, investing in private companies myself, that there are a lot of sharks out there, and it's definitely not as cut and dry as investing in a publicly traded company. There's no Yahoo Finance of private companies where you can go and look at 5 years worth of balance sheets and income statements, and get audited financials and SEC filings and things like that.
Sure.
It's really difficult. They can hide things. They can take advantage of people.
Okay. So while it might be legal now to invest this way, it's not necessarily accessible because
definitely
it's confusing.
It's confusing. It's not easy. You have to know where to look for the companies. It's not like these companies are out there, cold calling, like Joe and Joe and Cindy or whatever, down the street.
But you're in contact with them. How does that kind of work in terms of
working? We mentioned I worked at Morgan Stanley. I did some postgraduate work at Harvard Business School, and just over the years, I've built up this network. And I know I've met a lot of serial entrepreneurs, people who are just constantly starting new companies, selling them off, making exits, going back and starting something else. Lots of venture capitalists. I've met lots of guys who were stockbrokers who made money, like working in stocks, working in finance, like I did, and then decided they wanted to continue and become investors on their own. hedge funds, private equity. So I just like constantly built this network. I was always trying to meet new people and learn whatever I could from them, and then keep in touch with them, because one thing that I definitely learned being on Wall Street is that it is a lot about what you know, but it's really more about who you know.
So you're kind of, in a way, like you're playing Cupid or matchmaker between these companies that are looking for funding and the Main Street investors who are trying to make some money off of these private placements.
Exactly. These companies know that that I am a private investor myself. They know that I have access to other people who are accredited investors. They know that I know hedge funds. And so they reach out to me and they're like, hey, we've got this great idea and we're looking for funding and we're offering this super discount on these shares. Do you know anybody who might be interested? And after fielding years and years of these phone calls, there's only so much money that I can invest personally, and there's only so many companies that I can invest in personally. But a lot of these companies are really, really good. So I started sort of letting them know about this crowdfunding market, these Reg A rounds and these Reg CF rounds, and the ability to access retail investors. But then they would come back to me and be like, but how do we do that? Do we just get a phone book and start calling people? And I was like, you know what, you're right. We really need a community where we can bring these companies and these investors together, but where we can also, vet these companies so that the investors aren't just getting everything thrown at them, but are really only getting, the companies that I would personally invest in.
Okay, so that was the next thing I wanted to ask. What exactly are you looking for, and how are you filtering these companies? Are they, as they're coming in? Are you kind of just winging it? Do you have some sort of system, or what's the deal there?
No, definitely. So the first thing I look at, I'll just say I have a system, and I've called it the T.I.M.E.R system. And basically the first thing I look at is the team, the team behind the company, because I would say, over all these years, I've met a lot of people and I've met a lot of great people, but I've also met a lot of not so great people. And I feel like life is way too short to work with people that you don't feel comfortable around, that you don't feel that you can trust.
Sure.
So the most important thing is the team. Can I invest in these people? And if I feel comfortable with them and I feel like they would be a good investment, then we move on to the idea. What's their idea? Do they have a big, like, bold idea? Are they like the next Airbnb where, everybody's like, oh, we should start a hotel because we can rent out rooms in a hotel. And they're like, nah, man, like there's all these houses around. Why don't you just rent out rooms in houses? That was a huge idea. But you can have a really, really great idea. Like Pets.com was a great idea. Chewy has been an incredibly successful company, but Pets.com did not have what Chewy has, which is the market. Chewy had a market, and Chewy, had the technology to be able to make money shipping pet food. But Pets.com tried to do the same thing and they just didn't have the market. So the next thing I look at is the market. And, you have to have a big market. Either there has to be, millions, billions of potential customers, or there has to be, one or two customers with billions of dollars to spend. So it has to be a big market. So you've got the T, the I, and the M, right?
So that's the team, the idea, the market.
Exactly. And then I want to see execution.
Okay.
I want to see them executing on their idea. They can't just have the idea and then be out there looking for money. I really want to see that they're executing on that idea already, that, they're putting their own sweat into it. They're putting their own money into it. And that they're already getting to work on this.
Sure, it can't just be a pitch deck.
Exactly. It's got to be more than a pitch deck and a website. And you'll find a lot of companies can raise a lot of money with just a pitch deck and a website. It's honestly kind of scary.
Yeah.
So I look for execution, and then finally I look for companies that are setting up roadblocks for their competition. Right. So, if you're a small company, a startup, say you and I have a great idea, we're a great team, we've got a huge market that we can sell it into, we're already executing on it, and, Facebook or Amazon or Apple or Tesla finds out about it. Well, they've got billions of dollars. They can either, they can basically just come in and steal our thunder, So what kind of roadblocks do you have that prevent somebody from doing that? And, in some cases, it could be as simple as like, we've already spent $1 billion developing this technology. Somebody else is going to have to commit $1 billion if they want to catch up to us. Or, it's taken, 10 years to develop this. Somebody else is going to have to put in 10 years if they want to catch us. But what I really like to look for is patent protection. intellectual property protection, because if you have a patent, you've got 20 to 40 years of basically no competition to execute on your business plan. So I look for the team, I look for a good idea, a huge market, a company that's already executing, and a company that has roadblocks to keep the competition from coming in and sort of taking the market away from them.
Okay, so let's assume that you find a company that matches all these, things in your T.I.M.E.R system and you say this is a good company to invest in. How do you communicate that with someone who's a member of Main Street Ventures?
Well, so I send out, weekly updates to the Main Street Ventures community just to sort of let them know, what I'm looking at, what's going on in the, in the private equity world, in the venture capital world, what I'm seeing, what I'm hearing from my contacts. And I call those just, Main Street Ventures dispatches. But when I find a company that really just hits all of the buttons, and checks off all of the boxes, and I think this is a great investment that I really, really want, everybody else to see and know about, I send out what I call a deal dispatch. And the deal dispatch breaks down all of those criteria that I just went over: the team, the idea, the market, the execution, the roadblocks, and very simple to read. It basically is a really simple to read report. It explains all of the details of the deal. How much we're paying per share, how much the company's valued at that price per share, the minimum investment, the maximum investment, and if there are any limitations. Because there are some limitations with these regulation crowdfunding and regulation A+ rounds. It doesn't matter how much money you make or how much money you have, you can invest in them. But depending on how much money you make or how much money you have, that sort of that will dictate how much you can invest in these companies. So basically, they don't want people getting investing like 100% of their net worth into these startup companies.
Gotcha.
Because really, honestly, 9 out of 10 startups fail. And I would like to say, and honestly, our track record shows that we're doing better than that.
I do want to go over that in a minute.
But like most, the majority of startup companies fail, and so you don't want to put all of your eggs into one proverbial basket. And they actually have rules in the crowdfunding space to prevent people from getting too excited and doing that.
What about the actual process of investing? Is it as simple as signing onto a brokerage account and doing it? How does that work? Is there a lot of paperwork?
It's a little bit more complicated than just signing into a brokerage account, because you're sort of going to have to, when you set up your brokerage account, you fill out all the paperwork once. You fill out all of the information, you give them your social security number, they do their anti-money laundering stuff, their know your client stuff, they figure out who you are, they give you your account, and then you're good to go. Every time you log into that account, they can just reference that paperwork you already filed. But when you're investing in private companies, you sort of end up having to fill that paperwork out with each investment. But other than that, it's basically just as easy as buying a stock in with your broker.
Okay. I want to take a couple minutes here to, I guess, get some context in terms of some of the deals that you've looked at in the past, some of the past deals and the performance. So what I did before I came in here is I printed out your portfolio.
Okay.
I have some of your
on my laptop too.
I have all your open positions. I have your different categories of investing. I'm just going to kind of walk through, and hopefully you can help me out and put some of this stuff in some more context.
All right, for sure.
So you currently have 19 open deals.
Yes.
And these are all private deals, right? Like private shares?
Yep. These are all private companies still. None of them trade publicly. Like you can't go to, E-Trade or Fidelity or whatever and type in a ticker symbol. The ticker symbol doesn't exist yet.
Okay. And your average gain per trade right now is 40.88%, which is pretty impressive, but it's actually more impressive than that because this number is getting dragged down by a lot of zeros. And we'll put some context, I think, into why those zeros are there, but none of them are losing. You have 0 losers.
Yes, we have not made a losing investment yet. So there are a bunch there that shows 0% gain. And that's basically because we've invested in the company. The company is now using our investment to grow and hit milestones. But with private companies, it's not like a stock where it's repriced every couple of seconds when people want to buy and sell it. A private company gets repriced every time they raise money. So this 0% basically just means that these companies haven't needed to raise more money yet. They raised the money and now they're using that company or that money to grow. But so we've got, like you said, there's there's a good number of, 0%, but these are all companies that are in the process of spending the money that we help them raise.
You're sitting there and you're waiting for those companies to go public.
Exactly.
And to me, I guess it's important to talk about, like, every investing strategy has its, pros and cons. And to me, this is the one con of this investing strategy is that you're going to have a little bit less liquidity and you have to have a little bit more patience.
Yes.
But in the
Definitely.
end, I mean, it definitely seems like it's worth it based on all of the deals that you have exited have been profitable. You haven't exited a single unprofitable deal since you've started the service a couple of years ago. So to me, that's super impressive.
And that's sort of what I was really going for with Main Street Ventures is that, we vet every single one of these companies. I speak with the founders, I speak with the executives, I speak with, other investors, maybe people who were their angel investors, things like that. I really dig into them. And I got to say, I probably turned down like 75 to 80% of the companies that come across my desk, because, for one reason or another, a lot of times, their valuation's too high. They're sort of pricing imperfection, and it's really hard to hit perfection. And if you have priced imperfection and don't hit it, then, you have to do what's known as a down round where, I invest at $1 a share and then you don't execute how you're supposed to. And the next person comes in and gets to invest at 50 cents. And now I'm down 50%. So that's definitely, we don't want that. We haven't had that yet.
Okay. Can you tell me a little bit about these the high yield income section that you have? So are there actual funds that are private that you can invest in? How does that work?
So there are. One of them that we have on here is offered by a company called Yield Street, and it is available. Yield Street offers lots of different funds. Many of their funds are just for accredited investors, but some of them are for regular investors, retail investors, basically, non-multimillionaires. And one of the ones that we have, it pays 8%, or its goal is to pay 8% annual yields via quarterly distributions. So it's basically like owning a dividend paying stock, but you're not trading it on the open markets. You're not seeing you're not experiencing the capital appreciation or the capital depreciation.
Gotcha.
You're just collecting those yields. And then once you're ready to exit, you let the company know, they return your principal, and you get to keep all of the interest that you have. So we've had that one on for a little bit over a year now.
Okay, great.
We've gotten paid 8% in interest. So that's awesome because I mean, like we're going through this super high inflationary period, and so like these people are actually. They're making money like pretty much everybody else. Your bank account's losing money through inflation. The cash in your pocket is losing money through inflation. The stock market was crashing all last year. And yet, not only did we not lose money with this investment, but we actually beat inflation too.
Okay. Do you ever expect these funds to go public, or this is more of a
I would imagine so. So the one that I was just discussing, I don't expect that to ever go public, to be honest.
Yeah.
It's probably going to stay private, but it's going to continue to accept non-accredited investors. The other one that we have is actually a debt investment that we did in a private company. So it's not a fund. It's actually, we gave this company a loan. And the deal was that they were going to borrow our money for 3 years. They were going to pay us 17% interest per year. And then at the end of 3 years, they're going to give us back our cash.
Okay.
And I mean, 17% annual interest, like I couldn't turn that down. So we've held that one for about 2 years now. And we've got a 34% gain on it.
Okay, that's pretty impressive.
Awesome.
Let's look at some of these Reg A companies. So most of these you haven't. A lot of these are from the currently open positions, and most of them are reading 0% because you haven't exited them yet.
Correct.
There is this one that's reading 2.5% gain. Is that a company that went public and you're still sitting on it? What's the deal with that?
So no, this company's still private, but they have hit a lot of milestones since we first invested in them. And they recently filed to raise a new round towards the end of 2022. And it's at 40% higher than where we invested. So, this company is part of the smart home industry, is how I would describe it. And, like smart homes, when you can tell, your smart speaker to turn on your lights, open your windows, close your windows, all of those, change the temperature, whatever, pour yourself a glass of wine. I don't know if there's any machines that do that yet, but I'm sure there will be soon. But anyway, this company, they've just made a lot of progress. They've got, let me see, they sold out of their first generation device and have their second generation device on back order also. They're rolling out, I think, 3 new devices this year. they've got a smartphone app that makes it a little bit easier to connect. They've also got they're also adding an actual controller so that you don't have to use your smartphone. Say you're not comfortable using smartphone apps or something, or you don't want to download an app. But they've like gotten deals with assisted living communities, with hotels, with business development companies, companies that are developing office buildings and things like that. And they've also brought in a lot of strategic advisors and board members from other much bigger companies that are in the smart home market. And so one of the things that I really like about this is I mean, it's a great company. But if you look at the valuation they came out at, we invested at a $32 million valuation. And they already had the device. They already had sales. They already had international penetration, patent protection, and they had this very reasonable valuation. And not long before this company came to me looking for funding, Ring, the video doorbell, had been bought by Amazon for like $3 billion. So this company came with a $32 million valuation. And what they have is something that I think people would like even better than Ring's video doorbell. So there's a possibility that they get bought out. I think that that's their main goal, is to actually get, bought by one of these larger companies. But, if it would maximize shareholder value more to go public, then they're going to do that too. And we'll get the excitement of selling our shares into an IPO.
All right. That one definitely sounds really exciting. Are there any others in this Reg A category that you think stick out? Zen Labs sounds really familiar, but I'm not sure exactly what that is.
So Zen Labs was a cool investment. Zen Labs is a California cannabis company, but it's not your normal California cannabis company. And I can talk about them really openly because their round's closed right now. So, they're not raising any money right now. They we're looking to raise around $20 million in this round. I think they got to about 18 and they decided that was good. And what Zen Labs does is they do a couple of different things. They act as a nursery basically for cannabis plants and hemp plants for CBD and THC. And so they have all the licenses to grow these plants and sell them and, process them and manipulate them and everything. But what they do is they will say you are a cannabis company, like you own a cannabis company and you grow cannabis and you sell cannabis, and you're paying licensing by the square foot, right? But you have to keep this one plant that's known as the mother plant that you're never going to actually get any cannabis from. What you're getting is other plants from it. You take cuttings from it and you put them in the ground and you grow those. And so that's a waste of space, and also like as these plants age, they're like us, as we get older, we're not quite we don't have quite as much vitality as we used to.
Sure.
And I feel that every time I go to the gym, or every time I drink too much.
That's true.
The gym is much more frequent these days than the drinking too much. But yeah, we just don't have as much vitality as we get older, and plants are the same way. So what Zen Labs offers to do is basically take your plants and like strip their DNA down to, the best part, and then what they can do is you call them and you're like, hey, look, we want 100 young plants of this variety that we stored with you guys, and we want them by this date. And Zen Labs will take those plants and they'll start them in their nursery. And by the time you get them, these plants are all weaned and ready to just drop in the ground and start making weed with them.
That's pretty incredible.
It's really cool. And that's how regular farming works. Tomatoes, right? Farmers that grow tomatoes don't go out and plant tomato seeds. What they do is they buy tomato plants and then they drag this machine behind a tractor and it drops tomato plants into the ground. And so, what I saw with Zen Labs was, sort of the next step in the cannabis industry. The cannabis industry is still really in its infancy. It's been around for a while and it went through that explosive high growth phase. But now basically, investors are seeing that these companies aren't profitable. And they've got these really high expenses. And one way that you can cut down on your expenses is by using a nursery like Zen Labs. And so Zen Labs was really unique in that it was a private company, a relatively young startup, and it was already cash flow positive. So basically, it didn't need our money to grow. It needed our money to accelerate its growth. And that's exactly what it's done. And so...
so there's your execution.
Exactly.
Gotcha.
So they were already executing. The team behind it was really great. and they have patents on their process. And also, it's really difficult to get these licenses to grow THC. There's a lot of red tape that you have to go through. So they already had all of this stuff, and they had a really reasonable valuation at $45 million.
Okay. Look, we got a ton of these on that list, so I just want to keep moving.
No,
and we
definitely.
can move on to the
I mean, I could talk for hours about each
I
of
know
these
you could. I
companies.
feel like
I'm really
we could-
excited about
yeah,
all of them.
So the regulation CF.
Yes.
So you've got a
Now,
bunch
these are like legit, these are startup companies. So
Yeah.
this is what people think of when they think of startups. This is, where like maybe like a little bit further on than where Tesla was when Elon Musk, became an investor in it.
So does that open up an opportunity for, I mean, obviously maybe there's a little bit more risk, but are the rewards higher here? Because I'm looking at one of these companies, which you have sitting on a 600% gain.
Yes.
The equity.
Yes. And I actually need to update that gain because it's bigger now.
Okay.
So it's there is definitely, so there's more risk because like I said, at this stage, at that like early startup stage where like they're getting that seed funding, and the regulation CF is definitely seed funding.
Yeah.
That is the highest risk like stage for any company.
Yeah.
It's sink or swim at that point, and if they do well, man, they can do really well for you. You think about, I know I've used this as an example before, but Jeff Bezos got funding from his family to start Amazon. And these people put in maybe like $10,000 to $20,000 a piece. And every single one of them are billionaires from that investment, So, but they could have lost that $10,000 or $20,000 entirely and then just not wanted to see their cousin Jeff at the family reunion.
Sure. Well, I mean, it sounds like a bet that is, obviously paid off. And
yeah, for them, for sure. And for us with it has too. Was a really like, this is the thing, is this is the least sexy company I've ever invested in, but like probably one of the has some of the best potential that I've ever seen. They deal with manure. They basically found a way to reduce the greenhouse gases that come from protein farms. Protein farms being where we get our pork and our beef and the meat that we eat from. And so they found a way to reduce the greenhouse gas emissions from that. And the end result is a low smell fertilizer that's completely natural and clean water that you could literally drink if you wanted to. The rule in the US is that there has to be a lagoon on any protein farm. And usually what they do is they just, mix the manure with water and put it into the lagoon. And then, the bacteria and microbes do their thing. But, that process sends off tons of methane and tons of carbon and like all of these different toxic greenhouse gases. And so basically what they figured out how to do was to eliminate that step of the process. And so you still have to have the lagoon, but on a farm, that lagoon is filled with fresh water and has koi fish swimming in it.
Pretty crazy.
It's really cool.
Okay, I want to take a look at some of these closed positions, or just I might just run through them.
Mm-hmm.
So your average gain per trade on your closed positions is 60.06%.
Correct.
Pretty damn impressive.
Not bad.
I think most investors would like their average investment to be.
And 4 for 4. I love that. I mean, you can't win them all. I want to stress that. I can't stress that enough. There will most likely be companies that we end up losing on, but 4 for 4, that's definitely a better track record than just about any private investor that I've ever met.
Yeah, so they're all winners, and you even got a double digit or a double right here.
Yep, we got a double
100%
digit
gain.
We got a double. We got 100% gain. We have a 60 about 67% gain. We'll call it 66 2/3%, but we can round up there. And then on the same company, we got another about 13% gain. And that's because in some of these rounds, when you invest, you not only get shares in the company, but you also get what's known as warrants.
Okay.
And a warrant is kind of like, I use the term option, right? For people who are familiar with public investing, with buying stocks. Options give you the option to buy or sell a stock at a certain price before a certain date. Warrants basically do the same thing. So with this company, we invested in the company at a price of 50 cents per share, right? And then we also got what are known as half warrants. And half warrants entitled us to buy a half of a share of the stock. So if you have 2 half warrants, you can buy 1 share of the stock and you pay 75 cents per share. So those warrants, usually they come, there's a period in which you can exercise them. And, like after that period, they're gone. You can't use them. So if the stock price doesn't get up above the warrant price, usually they just expire worthless. And that's okay because really all
There's
you
no
wanted
loss.
was the stock anyway.
Yep.
These are just sort of something that sweetened the deal. But with this one, we were able to, after our lockup period ended, sell the shares for, let's see, we sold the shares for $1.10. And we were able to exercise the warrants immediately and sell those for $1.10 also. So the shares we bought for 50 cents, we sold for $1.10. The warrants that we paid those shares 75 cents for, we sold them for $1.10. So, we did pretty well on that.
Okay, so these are all deals that your, existing subscribers or past subscribers have been able to benefit from.
Yep.
What about anyone who's interested in joining Main Street Ventures? Are there any upcoming deals that you're eyeing right now that you think are particularly
I did mention that I
interesting?
have to update gain percentage because they are going to be listing a new round soon. And so their new round's going to be at $10 a share, which is a lot higher than the $1 a share that we initially invested in. But they've hit a lot of milestones. They've really proved that they're worth that kind of money. And even at $10 a share, their conservative projection is a 300% ROI on that investment. So that puts the $1 a share investors at potentially a 3,000% ROI. But still 300%. I mean, you can't say no to that.
So you're thinking about playing Cupid one more time.
I think we might.
You're considering.
I definitely like Fireman. I love the team. I really haven't met a better team of people than the ones running that company. But there are other investments that are going to be coming up too. There's a company that I'm really excited about. We've had problems with microchips. And so much that Congress passed the CHIPS Act to try and get microchip and semiconductor manufacturing back here in the U.S. But the thing is that semiconductors are all printed on silicon. Right. And they use some other things, but basically, mainly silicone. And the current technology that they use is limited. And we're starting to get to this point where you can see that there's a plateau. We're reaching a plateau where we just can't fit any more circuits onto these chips that we have. So the current technology is sort of peaking out. At this company, it's not the only company working in this industry. But basically, they're using a different type of material known as gallium nitride. Gallium nitride, it's just a better material than silicone for making semiconductors. The process to make it doesn't release any toxins like it does with silicone. You can fit more connections onto these things. And the issue is, though, that it's really, really expensive to produce these. And most of the companies that are working at it can produce 12 of them a month. And who needs 12 semiconductors a month? We need millions of semiconductors every month. And so what's special about this company is that they have figured out how to manufacture this stuff at scale. And they're going to be raising money to build a manufacturing facility to actually do this. And I've basically been saying, as I've been investigating the company and learning more and more about it, that they're going to have to change the name of Silicon Valley. It's not going to be Silicon Valley anymore. It's going to be this company's Valley.
Yeah, you told me about this a couple months ago, and I at the time you said that it was, it was definitely too early, but you were eyeing this company, and I found it extremely exciting.
I'm really excited about this one. I mean, this is going to be, and it's going to be a Regulation A round too. So, I mean, the company basically, this is their last step before going public.
Sure.
And I can totally see this one, as a public company having $1 billion price tag on it, or higher, maybe even 10 billion, 100 billion. I mean, the possibilities are really limitless if they're able to do with this investment round what they plan to do.
Okay. Is there a general target date that you think that maybe this round might be opening, or is it more?
Honestly, I think within the next 1 to 2 months, maybe 3 months at the outside. So within the next quarter, I expect this company to open its round to retail investors, and I definitely expect to be recommending it to my investors.
Okay, great, and they'll be getting one of those deal dispatches.
Exactly.
All right, Jason, I'd love to keep talking, but I feel like we've covered most of the basics, and I think what we'll do is we can drop a link below, and you can maybe explain a little bit more about, Main Street Ventures, how to join. I strongly recommend anybody who's watching this to, check that out. And again, there's no income requirements. Yeah. Just probably a few simple clicks, and Jason will make it as easy as possible to get started.
If you're 18 years or older and you have an internet connection and some way to access that internet connection, you can be a private investor too.
All right, cool. Jason, thanks for coming on the show. Everyone else, good luck. And
All right. Thanks for having me. Take care, guys.
see you.